Good afternoon, everybody. On behalf of Colliers International and our guests from McCarthy Tetrault, I'd like to welcome you to our webinar discussing the current state of the Montreal commercial real estate market. This session will be in English, as we are hosting a number of out-of-province participants who have interest in the Montreal market. Cette session sera en anglais parce que nous avons un certain nombre de participants au Québec qui ont de l'intérêt pour le marché montréalais. Thank you. Normally in a dynamic and fluid market, it's challenging to stay abreast of news and factors that affect one's ability to do business. Needless to say, the COVID pandemic has thrown a curve at personal and business life alike, and those challenges have increased exponentially. As the situation evolves, more and more issues become apparent. Lately, government and business leaders around the world have begun discussing logistics related to reopening services and to bringing employees back to work. But still, here in the province of Quebec and across the country, the realities of the health crisis have incited government measures that are still undetermined in terms of length of time. And as a result, although there seems to be a light at the end of the COVID tunnel, uncertainty still prevails. While we've seen many attempts to read the effects and forecast outcomes of the unfolding situation from a global and national perspective, we here wanted to take a particular perspective on how the crisis has affected the various segments of the Montreal commercial real estate market. We wanted to discuss legal implications as they relate to lease obligations for both sides, party to lease agreements. And lastly, we wanted to discuss what lasting effects we expect to survive our response to the pandemic. Towards that end, Colliers International has assembled a panel of experts, each in their fields, including a special guest from McCarthy Tetrault. Our panel's wide client base allows for a broad view of Montreal and how our city is responding to the situation at hand. Here's a quick introduction. James Papadimitriou is a lawyer, partner, and group lead with McCarthy Tetrault's Real Property and Planning Group in Quebec. James Gang leads Colliers Valuation Group, which is involved in the valuation of premier investment properties and major portfolios across Canada. Janina Franciscuti brings 25 years of advisory experience in real estate sales, specializing in prime investment grade assets and income producing properties. Janina represents both institutional and private investors. Jean-Marc Dubé, who we affectionately call Mark for short, has over 15 years in business and focuses on industrial property in the GMA for both landlords and occupiers. Mark and his team are the #1 industrial listing team in the Montreal area. And certainly, last but not least, André Plourde, his team represents or has represented some of Montreal's largest property owners and key office developments, such as Royalmount Project, Solar Uniquartier, O'Milex, Windsor Station, the Deloitte Tower, among many others. So I'm going to ask each of you to give us a brief overview of your business and the general market response to COVID-19 within your specialty, after which we'll have a round of Q&A. So I'll start with you, André. For frame of reference, can you provide a brief description of the Montreal market and how tenants and landlords in the commercial office leasing market have dealt with the situation?
Things from beautiful Mont-Tremblant, where I've been confined for the last 5 weeks without access to my beard trimmer, nor to any proper dress shirts, so apologies for that. I think before talking about what we're going through right now and what to expect as we emerge from this health crisis, it's important to have a look, to reminisce ourselves where we were just ahead of the crisis. Canada, on a global basis, is doing pretty well. Quebec was doing extremely well, generating hefty surpluses, and the greater Montreal area was obviously benefiting from that momentum. Montreal has a population of over 4 million people, which represents half of the province of Quebec. We're the second largest city in Canada. We attract on a yearly basis over 50,000 immigrants. We have a very high concentration of high-tech businesses. We've got 5 major universities that every year produce thousands of skilled bilingual graduates. Our provincial government provides some of the most generous tax credits in North America to gaming and special effects studios. And we also have one of the largest concentration of artificial intelligence scientists, and are home to one of the most prestigious group of deep learning researchers, the Montreal Institute for Learning Algorithms, better known as MILA. So how do these positive key indicators have impacted the office market vacancy as of the end of Q1 2020? So the total office inventory for Greater Montreal sits at approximately 100 million square feet. And at the end of Q1 2020, vacancy stood at 8%. If we focus down to the downtown market, the inventory sits at about 55 million feet, and our current vacancy is as low as I can remember ever seeing it throughout my career at 6%. And now the Q1 2020, we've had a positive absorption of 100,000 square feet, which is more or less in line with the 1.4 million feet of absorption over the last 12 months. Now here is where it gets interesting for the best of class office buildings in the downtown core, class AA or A product. For a tenant seeking an immediate requirement of 50,000 square feet, there are only currently 6 options throughout the market. For 100,000 feet, there's only 2 available options for a relative quick occupancy. And for 150,000 square feet and up, there are currently no opportunities. So strong demand continues to come from the tech sector, and they typically seek larger blocks of contiguous space. Now, companies have adapted very well and very quickly to working from home. So, you know, one can question himself, what impact is that going to have on space requirements going forward? Well, although there are many advantages to working remotely, a lot of industries are finding it challenging for employment engagement and interaction. One thing's for sure, there's a lot of uncertainty at the moment. Companies that are obligated to contract because leases are coming up, or they have to make decision exercise options to renew or whatnot, are definitely seeking shorter term and flexible conditions. You know, decisions to expand are being postponed, and partly because of travel bans. I mean, American companies cannot come to Montreal, and this is definitely causing some softening of the market, but we're not foreseeing any drastic meltdown. Now, let's remember that Montreal has a strong ecosystem of gaming and gaming testing companies, and these are doing extremely well right now. Now, for sure, companies are rethinking, you know, how to plan their space. It's pretty obvious that density will be having a second look at density, and it might come down going forward. We will be definitely witnessing an increase in unassigned seating, and we're going to be hit by, you know, continuing rise of construction costs. However, we are not, you know, by any measure expecting a market meltdown. As the fight to attract and retain talent continues, so will the flight to quality. So there are very limited options for large blocks of contiguous space in the top buildings and limited new supply in the pipeline. Ça va bien aller. Thank you.
Thanks, André. So all sectors have been touched by the shutdown. Marc, your team is extremely active, representing landlords and tenants across different sectors of the industrial market. What are the immediate impacts of Montreal's industrial real estate sector?
Well, thanks for the question, Colin. Bonjour tout le monde, and shout out to André on the containment beard. I quite like it, and I'm very happy to be wearing a blazer after 6 weeks. Look, I think it's really important for us to understand where we were, as this will influence where we are now and where we're going. In general, if we look at the Montreal industrial market, we were firing on all pistons. Q4 2019 was record low availability, record low vacancy, record high net rents. As long as I can remember, Montreal was always a $5 market. We are absolutely no longer a $5 market. And Q1 2020, we saw all of those trends continued. We still had the lowest availability and the highest rents that we've had in history. The availability rate fell to 2.5% from 3.3% in the last quarter of 2019. Our vacancy rate right now is sitting somewhere around 1.5%. Actually, not a healthy vacancy rate, in my opinion, because there's a major space crunch in the market. Net rents rose year over year about 16% to bring us right to underneath $7 net. And I think important to note that that includes all asset classes, everything from a 14-foot clear building right up to a 40-foot clear building. And another important thing to note about Montreal is that we're still well under the averages of other major industrial markets in Canada, which actually gives us a bit of growth in the rents, or potential for growth in the rents. And I think the other thing that's really important that's affected Montreal's availability rate is there's been virtually no new supply at all delivered in the last 5 years, and which is creating a serious supply issue. Montreal developers had planned to put in about 1 million square feet of spec building between late 2020 and early 2021. And a lot of that's been halted now. So the only spec buildings that we've seen that will be delivered in 2020, there's a 90,000 square foot building being delivered in Laval, another 135,000 and change in Terrebonne. And both of those projects started before COVID. So where are we now? What's happening now? From a street broker, we're getting a lot of calls, inbound calls coming in. A lot of third-party logistics warehouses are running at full capacity. So there's a space crunch there. Food distributors are also running at complete full capacity. They're really quickly running out of space right now, especially in cold storage. There was already a lack of cold storage space in Montreal. So there's a high demand for food grade DCs, which is not a surprise because people that weren't ordering their groceries online are now ordering online. So there's also been a major push for e-commerce in the market. That had already started pre-COVID, but let's just say now it's gone into complete hyperdrive. So we're seeing a lot of temporary requests from supply chain clients looking for anywhere 6 to 18 months. And there's no surprise to that either, because if you have a regular company turns their inventory 4 times a year, if that inventory now is only turning twice a year, because of the lockdown, the goods that are coming in have nowhere to go. So containers are coming in, the port can't keep them, they're shipping them to warehouses. The warehouses are not shipping to brick and mortar retail, so those goods need to go somewhere. So we have a lot of demand now for temporary space. And I think if we were looking at who's been hit the hardest so far, it is early in the events, but it's the smaller companies in smaller, we'll call it, smaller spaces, 18 feet clear, less capitalized, the companies, and especially the ones that are really hitting towards and shipping towards the brick and mortar retail. Still a lot of textile and fashion companies that are in Montreal that are directly related to the to shipping. So I believe that those small companies are the ones that are going to be hit the most.
Thanks, Mark. With the proliferation of e-commerce and online shopping, I wonder if the demand for temp space will continue to be temporary, or if they'll turn into long-term requests. That's really interesting. Janina, what type of insight can you share with us? What have you been hearing from the investment community?
Well, first of all, for all of you out there who have a family member working in the front lines, please be sure to thank them, because it is because of people like them that we are in much better condition than what we thought we would be. So What are we seeing? Well, as Marc and Andre indicated, we're coming from a market, a booming market. Montreal was on fire. The buzzword was MTV, Montreal, Toronto, Vancouver. We were getting a lot of attention as a major market for investment from institutional players. Cap rate, every deal was setting benchmarks in terms of cap rates. Vacancy rates were coming down. We were seeing growth in rental rates. Montreal was basically on fire. And then COVID-19 came along and the government pressed the panic button and the economy basically came to a halt. This gave us the time to, or the government to assess the situation and put together a plan of action, which they have implemented, and it has worked quite well. The recent results indicate that we're far below the curve that they originally expected, and now we're looking at a path to recovery. They're starting to talk about reopening sectors of the economy, sending the kids back to school, and so forth. So where does that put us now from an investment point of view? Well, institutional investors are on the sidelines. Acquisitions and dispositions have been put on hold. Attention is on asset management. It went from addressing the shutdown of buildings to now asset managers are focused on reopening plans and dealing with the slow startup of the economy and how the buildings will adapt to that. Social distancing will remain. How do you deal with social distancing with elevators, for example? All of these items need to be addressed by property owners as the economy starts to get rolling again. Private investors are out there looking for opportunities. They're looking for opportunities at discount pricing, and unfortunately there are none. We're not there yet, and we have not seen distressed situations. So there hasn't been any trades. The market is basically at a standstill for the time being until things start to pick up again. So assets of concern, as we come out of this, I think industrial is going to come out smelling like roses. It was doing very well before and will continue to do so. Office assets will have to adapt to some certain changes in the way that we live and the way that we use space. Retail, food-anchored retail has always done well and it will continue to do well. Enclosed malls with a high fashion component were struggling before and will continue to do so. Those properties will have to be revisited in terms of highest and best use and potentials for redevelopment, densification, which was ongoing previously. Multi-res, I think the multi-res sector will do well. We might see a little bit of a glitch in occupancy resulting from the freeze on immigration, which is temporary. But the asset class that will probably have the biggest impact is senior housing and specifically long-term care facilities for obvious reasons. So all this to say, in conclusion, I think that in general, we are starting to see a light at the end of the tunnel. Property owners are starting to prepare for the reopening of the economy, and that is where attention is now. Until that gets resolved, investment activity will always be on the back burner.
Right, so a lot in play over, I guess, the next weeks and months, certainly. James G, and excuse me for calling you James G, just to differentiate between James G, Gang, and James Papadimitriou. So James G, we've heard from Andre, Marc, and Janina, all of whom are active on the ground and involved with clients both on a strategic and on a transactional basis. Now, you assess various factors to arrive at asset values. So how has the crisis affected your underwriting?
Well, thank you, Colin. And first, I'd like to say that it's great that we kept the appraiser for the end, because God knows we're the sexiest speakers that there are. From a valuation perspective, the most repetitive question that we're getting is, how will a post-COVID world impact values. And to be perfectly honest with you, it'll be difficult to say right now till we see a sustained sales activity so that we can measure it properly. However, a lot of people are taking this COVID crisis, this health crisis, and comparing it to the economic crisis, the Great Recession of 2008. And there are some differences between then and now. Back in 2008, values were affected because activity ground to a halt. There was a lack of consumer confidence and there was an extreme lack of liquidity. The banks were in severe financial difficulty and a lot of them weren't in a position to lend, and the government's, the intervention was limited to the large corporations and the banks and trying to save the economy that way. Banks that were lending had built risk into their pricing, and by building risk into their pricing, spreads increased to a certain large extent. And in doing that, it forced the acquisition side to rebalance the equation in terms of debt to equity. And that's what helped push cap rates up. That and the fact that certain properties were in distress, people were trying to take advantage. That's much different than what's happening right now. Contrary to 2008, major steps were taken in quick succession. If we think about it, the Bank of Canada acted very swiftly. It brought down the bank rate to 0.25%, 100 basis point cut, and it provided a lot of liquidity to all segments of the economy. Both levels of government announced programs to help both businesses and the individual. These included income support, business loans and emergency financial relief, and more resources for healthcare, the retirement sector, and lower wage earners. All these measures provided immediate relief to the Canadian economy. In Q1 2020, we are actually tracking a whole bunch of sales along several asset classes. We're tracking industrial, we're tracking office, we're tracking retail, and multifamily. And to be very honest, the cap rates and the returns were more or less unchanged from the fourth quarter of 2019. But the most important reason for that is that while they closed in the first quarter of 2020, all of those deals were negotiated in the last quarter of 2019. Things that are ongoing, and it's been mentioned already, deals that are ongoing at the present time have basically been put on hold. Parties have agreed to extensions due to social distancing and government decrees on the halt of non-essential services. Due diligence is effectively stalled. Now, how this will affect market from an appraisal perspective, and do we anticipate values to be affected? I think it depends on the asset class. Things that we're going to look at as appraisers, though, will be a request for lease extensions, rent relief, bankruptcies, and the possibility of downsizing will cause us to rethink our analysis of our market leasing assumptions. We may look at lower renewal probabilities, longer downtime, and we may incorporate a little more rent, free rent at the front end of the analysis, as well as rethinking the level of tenant inducements that a landlord may or be willing to afford. And also we're looking at the end as higher vacancies provisions in the next, say, 6 to 18 months. If we look at it, and it previously mentioned, but if we look at them very quickly, the industrial market, as Mark has referred, has been extremely strong the past 18 to 24 months. There could even be a pent-up demand after being closed for 1 or 2 months. Various manufacturers may need to ramp up production to meet that demand. Therefore, demand for the industrial project may remain strong. In the longer term, though, a shift to more sustainable manufacturing, this panier bleu, as the government has announced, and a need for more warehousing may actually lead to increased activity in the mid to long term for industrial. The same can't be said for retail. Retail will no doubt suffer for a few quarters. I think the retail landscape is expected to suffer and change. Very quickly, if we look south of the border, in the last 10 to 15 days, 4 major retailers have announced that they've sought out advisors for restructuring, advisors for debt restructuring. Some of them missed some major bond payments. And all of that leads us to believe that there could be some major bankruptcies coming in the next 4 to 10 weeks. Now, we know Canadian real estate lags behind the US generally. It could be 6, 12, 18 months. I think that what we see happening in retail south of the border will work its way up to Canada to some extent. We're a little different in our exposure, but I do think that we will see a bit of a shift in the retail market. The most important thing for the retail industry will be consumer confidence, economic stability, and lastly, whether or not this has been a litmus test for shopping at home. People are still buying, they're just doing it differently. And the question will be, will bricks and mortar be replaced by computers and mouses? Multifamily market, well, multifamily is expected to remain strong. Multifamily is an essential service. People need a place to live. It's a stable asset. It provides slower returns, but it provides returns nonetheless. And then lastly, the office market. Well, Office properties may see mid to long-term shift in user habits. COVID may cause companies to use space differently. Will telecommuting be seen as a more viable alternative to having employees commute and work from home? It may be. And will its office space itself change? I think so. We could see less open concept design as companies with employees see how community transmission can propagate a virus. We can't be sure. But in summary, will values be affected? I think that over time, yes. This will be due to the following factors: stagger or higher vacancy rates, lower renewal probabilities, longer downtime between lease rollovers, adjusted tenant improvements, allowances, reclassification of risk based on tenancy. In the past, we had credit, non-credit, anchor, CRU. We would probably keep those definitions, but you may see us adding in essential and non-essential services in the description of tenancy. And then the last thing is the actual versus market rents. Depending how the market reacts over the next 6 to 18 months, if existing leases wind up being above market, well, we as appraisers, and nobody likes this, are forced to mark the market. If, however, the market resumes its buoyancy, then we won't have as much of an effect. Lastly, and most importantly, liquidity in the markets is going to be key. As long as the lenders and the banks and the financial institutions are able to lend, then the market will resume what I would call a sustainable level of activity. All these factors are what we as appraisers shall be watching and adjusting to, at least for the short to midterm. I think the next 6 to 18 months shall be very critical in terms of where our industry winds up going. And I think as an appraiser, we will probably be putting a little more emphasis on the discounted cash flow for multi-tenant investment grade assets when we consider these factors that I've just mentioned.
So it's going to be important to stay in touch with you, I guess, over the next few weeks to understand how things change and move. James P. Last week, the federal government began to describe assistance programs centered around rent relief for small and medium-sized businesses. Although many players have taken a "we are in this together" approach, you still must be receiving many questions around force majeure. Can you talk to us about what you're seeing from tenants around obligation to pay rent and rent deferrals?
Certainement. D'abord, Colin, merci de m'avoir invité sur ce panel et l'occasion de présenter avec les sommités dans leur domaine qui font partie de votre équipe. Yes, I mean, the initial phase of this crisis was about force majeure, although people are now starting to talk about work reentry and what does day one look like, and I see all kinds of panels and publications, government agencies issuing guidelines, WHO, CDC, and we'll see what happens with the Western provinces opening up soon. So the conversation is changing, but the force majeure issue and its consequences will be working their way through our industry for a while. While this is a legal presentation, I have to say that for now, anyway, we are not going to litigate our way out of this. Collaboration is the key, and what we're seeing is an incredible amount of collaboration leading to all those rent deferral strategies and discussions that we've been having. Early indications, and André and Mark and Janina will talk about it later, is that April was not a catastrophe or an apocalypse, although I guess retail landlords were probably drinking out of a fire hose on rent deferral requests. Sure. We'll see what May brings, as André said, but there is a sandwich effect, and the landlord is receiving all these deferral requests, some of them from opportunistic people, some of them will actually have are in dire need, and until a government program comes and alleviates the situation, will require this request, but they're going to have to go back to their lender and get an according or corresponding relief, and maybe governments will come up with some municipal tax relief. Nova Scotia has a program. As you mentioned, the federal government will see what their program looks like. So yes, the hashtag "we are on this together" is trending. And we're finding out that relationships matter and people are behaving in a very collaborative and compassionate fashion today. I just wanted to draw some distinctions between a couple of buzzwords that are being thrown around in the industry: force majeure, material adverse change, material adverse event, market flex. So I'll talk about force majeure in a second because you asked about force majeure. Material adverse change is a clause that we'll see typically, we saw in the 2008 crisis, that allows mostly lenders to withdraw from a funding and a commitment letter if there has been a material adverse change in their borrower and their major tenant base, maybe in the market, etc. So that's a pre-funding condition, and in the context of purchase agreements, which I'll deal with later, could be a sort of due diligence or pre-closing condition. A material adverse event is something that we'll speak to in a loan agreement that allows a lender to call a default if there's been a material adverse event in their borrower, the tenants, the borrower group, etc. And market flex will allow a lender to change their pricing. So force majeure, I'll get to in a second what the reality is. The reality is that 99% of the leases that your listeners probably, or our listeners probably, are dealing with and that we deal with will have a clause. But in the absence of a clause, you need an unforeseeable event. You need it to be irresistible. So the unforeseeable event is probably COVID-19. If you signed your lease before March 16th, declaration of the pandemic by the WHO, it has to be irresistible, i.e. a government order. It has to be uncontrollable. And most importantly, it has to render the performance of the obligations impossible. So classic examples are floods, states of emergency, strikes, and there is one case on the verglas, on the ice storm in Quebec. So if a landlord cannot keep their building open, and in what we're living in, the only landlords who have been ordered to shut down are retail owners. Everyone else has not been ordered to shut down per se. And as a matter of fact, we got calls earlier on in the piece from office owners, industrial owners. What do we do? What do we do? Well, invariably, they will have an essential services provider in those premises, and they cannot shut down. And so the bottom line is, in the absence of a clause, likely the finding will be that the landlord has been relieved from their obligation to provide peaceable enjoyment, and that the tenant, it's not impossible for a tenant to make a rent payment. The banking system is still there. You can still make a check, a wire transfer, etc. So having said that, that's for the 1%. On the 99% of the cases, there will be a force majeure clause in almost all leases. It may or may not include pandemics, epidemics, health emergencies, unless you sort of learned from SARS in the Toronto market and incorporated that in your clause. But COVID-19 in of and by itself is not the force majeure event. The force majeure event are the government orders that ensued and that ordered landlords to close and ordered tenants in some cases, in almost all cases other than essential services, to shut down. So what does that mean? It means, again, that the landlord will be relieved for all intents and purposes from their obligation to provide peaceable enjoyment. And if you're in a retail context, the tenant will likely be relieved from their obligation to continuously occupy or to remain open, but they will not be relieved from the payment of rent. And all of those clauses provide that rent is payable without set-off deduction compensation. I'm sure everyone's seen those clauses a million times. And if 99% of the leases have a force majeure clause, 98% of them will say that the tenant continues to pay rent regardless. So unfortunately, it's not a happy story for tenants. They're going to have to look at things such as government programs, relief efforts, as well as their business interruption insurance. And there's a whole sort of conversation around business interruption right now. I mean, landlords will have rental income replacement, tenants will have business interruption. Traditionally, under Canadian law, you require physical damage. There's been some recent case law that suggests that maybe this virus is part of the environment, and there's different parts of the policies that might be available. And while notwithstanding what I said about it's not a time to litigate and etc., there may be some claims around business interruption insurance that we may see coming even in conservative friendly Canada. So I hope that was responsive to the question, Colin.
Yeah, absolutely. But staying on that trend, that topic of rent payment prior to April 1st, we heard that making the rent on the first of the month would most likely be a challenge for many tenants, and depending certainly on the primary sector that they do business in. André and Marc, as your business is active involvement with owners and landlords, what have you heard from them, from your clients, regarding tenants' ability to pay rent for April, May, and for months beyond?
Let me start. So I've had numerous discussions with my landlord clients, and so on the office side, I would say that 90 to 95% of April was collected on time. We'll have to wait and see what happens on May 1st. But it might, the non-payment might increase a little bit, but I'm not expecting it to increase by that much. There's an exception for companies that are, that were immediately hit by the confinement measures, companies that have to do with travel or, clinics or whatnot. We have not witnessed any type of rental credits at best on a case by case, and when it's well explained and deserved, we have witnessed some rent deferral, 30, 60, 90 days maximum, but that's it.
Great. Mark, what have you heard?
Yeah, no, I agree with Andre. We've had experienced the same thing. We've surveyed a bunch of our landlord clients, and everybody's collected, somewhere an average of about 90 to 95% for April 1. It's definitely the topic of conversation, and everybody's trying to figure out what everybody else is doing. I would tell you that almost all the landlords that we've spoken to, everybody's willing to work with their tenants. They understand the situation, especially the tenants, the industrial tenants that are directly related to the retail industry. If rental deferments are requested or rental abatements, landlords are asking for financials, for business plans, and looking at what the percentage is that they're actually going to get out of this situation. And they're treating it really on a case-by-case basis, which I think is the right way to go. But I do expect that there will be more demand for rent relief on May 1st.
Sure, right. Andre, your representation is pretty diverse. You represent tenants in Midtown, downtown, A-class space, loft style space. What sort of activity are you seeing on deals that were already in progress prior to COVID? And are you seeing any new business?
Well, new business, no. It's transactional activity has come to an abrupt stop. There's a limited amount of inquiries and market surveys being conducted, and without the possibility of visiting space, we're not going to witness a binding offer being executed following a virtual tour. Now, leasing transactions that got executed just ahead of the crisis will be proceeding normally after this is over with. As an example, tenants that have committed to sizable expansions with the commencement dates, say of January 1st, 2021, are not, trying to backpedal their way out of the deal. What we might see is, if the confinement continues for a little while, there will certainly be some discussions on perhaps extending fixturing periods and moving back maybe commencement dates. But no, we expect things to resume. Obviously, we're at a standstill, and as the plan for business to reopen becomes known in the coming days, I think sometime next week, which was announced by our premier today, we'll see the light at the end of the tunnel.
Right. So, Janina, Colliers' capital markets team recently conducted a survey of investors, questioning them on sentiments on various factors. Are you able to share with us some of the results of the survey, just given the realities just discussed? How are the investors comparing the buy and sell sentiment?
Yeah, sure. So Colliers Capital Markets actually has conducted an investment survey in multiple phases. The first one was done a couple of weeks ago, and the second one, we just had the results issued today. And what was interesting was to compare the results of the questions from respondents 2 weeks ago versus what came in today, to see the attitude and how people are feeling about the marketplace. So I'll share with you some of the key findings. The survey, the results of the survey are available, and you can contact us to get the full survey. But the key findings were, for example, one of the questions was asking how investors felt, what kind of a timeline investors perceived before they saw some sort of market stabilization. And that has not changed over the last couple of weeks. The majority of people think between 6 to 12 months we'll see some stabilization of the marketplace. When asked about impact on values, this was interesting because the first time the question was asked, the majority of the people thought that values would drop between 10 to 20%, with a smaller percentage indicating a 0 to 10% drop in value. This time around, when we asked the question, a lot more optimism, and the indication is 58% indicated between 0 to 10%. So people are starting to think that the values won't be as impacted as we initially thought. When asked about timing for next acquisition, about a third of the respondents replied that their next buy would be in 6 months, which was down from 50% last time. So we're starting to see a little bit of uncertainty there, and that's further demonstrated when we asked with regards to the next sell, when would be the next property they put on the market. There, the results were clearly demonstrated uncertainty, with the bulk of investors replying they were not sure. Finally, we asked them about the top 3 market challenges for the next 12 months, and they were tenant solvency, pricing and valuation, and rental growth. So those were the 3 top areas of concern going forward over the next 12 months. So that gives you an overview of the results of the survey. There will be a follow-up in a week or 2 with the same questions and some new questions, but I welcome you to contact us and get the full results of the survey, which is Canadian, and we also have international questions too.
Thanks, Jean. It sounds like investors are looking for opportunity in terms of acquisition, but they're waiting to understand the situation a little when looking at potential disposition. Very interesting. James P., I was recently speaking with a group who was obligated to close on an asset during the month of April, and they were showing a little hesitancy. From your legal lens, what is the impact on COVID with regards to obligations on purchase transactions?
Good question. Before I address that question, I just wanted to go back to leasing a little bit. What we didn't talk about is subleases. And I think that's an interesting minefield, because if as the head tenant comes under stress, and if their lease disappears, the subtenant will have their own occupancy challenged unless they have a direct agreement with the head landlord. So I know there's a bunch of subleasing activity out there in the space, especially providers such as WeWork and et cetera. So something to bear in mind, the sort of precariousness of subtenants. Now, to your point on acquisition transactions, yes, the pre-COVID period was interesting because those documents were drafted without this context, et cetera. And we fortunately got a bunch of them under the wire before April 1, before there was slippage in rents and et cetera. So that was sort of pre-COVID deals. Post-COVID deals, frankly, been surprised with the volume. I thought it would be significantly reduced. It is reduced, but we are seeing activity. We have a number of refinancing transactions and a number of acquisition transactions. So, and for us, we're sort of become a virtual law firm, and we've figured out how to close virtually and with notaries and with title insurance and all that good stuff. So it's business as usual in a business unusual time, to take up the theme of the conference. And le mot du jour is creativity. So both James, Janina, and a bunch of people on this panel highlighted the difficulty with due diligence. So what we're seeing is staggered due diligence periods, an initial due diligence period that does not require physical due diligence, and a subsequent due diligence period for environmental and surveyors and the like, with rolling 30-day periods for that, with an outside date of, let's say, anywhere from July to August to September. So the biggest challenge is due diligence. However, we're in conversations with surveyors and engineers, and we're trying to see if we can't get those services listed as essential services, because if lawyers are essential services, lawyers need surveyors and engineers to complete transactions. So we're trying to make the case for them to be included. And as we see construction sites remobilized, personally, I think that they're going to be allowed to join that list sooner rather than later. The other big hot topic is estoppels. What happens with estoppels over these prolonged and longer sort of transactions as rent slippages occur and there's more arrears, so you'll have to deal with arrears. The vendor will have to be able to get a credit for those arrears because that came off the pre-closing period. Of course, they'll need the buyer's consent for arrears and abatements and etc. So what we're seeing is an accounting in the estoppel process for a slippage in the rent roll, and with some putting in a minimum net operating income backstop as they get to closing. If there's an existing mortgage in place, it's going to be interesting to see if more buyers won't ask for mark-to-market adjustments as rates go down over time, maybe into negative territory, who knows. To bridge the gap with the lower LTVs that we're seeing on the lending market, some are entering into discussions around balances of sale, and people are paying a lot closer attention to their co-owners agreements, limited partnership agreements, for things such as cash calls and dilutions and etc. as we move forward. So it'll be interesting to see if many of the documents people in my profession have drafted will stand the test of time, and how that all works out when the courts reopen. Because for now, I don't think courts will look too favorably on anyone trying to strictly enforce legal rights, whether it's landlord, tenant, or otherwise, in this environment until we get back to whatever the new normal looks like. I hope that was responsive.
Yeah, for sure. Absolutely. Thank you, James. James, gang, given what's been said and what you've added, what factors would be impacted most when you're underwriting?
I mean, appraisal is considered an essential service. So we've actually been working throughout COVID. And a lot of the stuff we've been doing has been financings. And what we've seen happen now, and James alluded to it, is that the lenders are still lending, the liquidity is flowing, deals are getting done. The only thing is that it's not an absolute value play. Loan to value isn't the underlying or the albeit factor that they're looking at. Debt service coverage is what they're looking at. You know, the interest rates, bank rates at an incredibly low, historic low. Interest rates within the banks are incredibly low. Spreads are still reasonable. So what the credit people seem to be doing is stress testing their loans at a higher mortgage rate, either on takeout or in balloon. And at the same time, they're looking for higher debt service coverage ratios because they're anticipating the possibility of some slippage in rent, as James has alluded to. So the activity's there. Our values are still being maintained based on current market dynamics. And I think what's happening is that the real estate market is reacting the best way it can with the information it has at hand. So, you know, our values significantly decreasing. They haven't yet. And loans are being done and lenders are active. They're just being a little more prudent, which is not a bad thing.
Sure, of course. Again, wait and see, and I guess a lot will tell over the next weeks and months, as I said before. So, Mark, as you talked about e-commerce previously, it's certainly benefiting from the quarantine. People are shopping online. People are ordering food, their products. It's an e-commerce world right now. What are the long-term effects on dedicated e-commerce space and other segments of the real estate market in industrial?
Well, you're right, Colin. I mean, Montreal has been experiencing a rise in e-commerce dedicated space, even pre-COVID. As I said previously, it's just really ramped up now. Amazon is in our market. They're moving very quickly now to grow their footprint. They're adding new employees to their existing facilities. We're seeing a big demand also for last mile locations. So these are buildings that will be as close to urban settings as possible, so they can get the product consumer. And we're expecting to see a big increase in e-commerce facilities that are food grade buildings, because people are going to start ordering a lot more food online. Land sales are at record highs. We're continuing to see acquisition on land destined to e-commerce. And I think we're actually going to see a little bit more contingency space, meaning that if a company has 100,000 square feet destined for distribution, they need to have a redundant site where if that site gets shut down due to a virus outbreak, that they can actually move their stuff to another location and continue operating. So I think we're going to start seeing some of those operations. And frankly, with no new speculative buildings coming to the market in 2020 and likely near the end of 2021, we expect that quality high bay industrial rents are going to stay stabilized. Maybe we'll see some slight increases even in those rents. We had forecasted very aggressive rents increases, but I don't think we'll see those aggressive increases. However, we do expect to see stability. I think the biggest issue post-lockdown is going to be the lack of any type of large bay high cube space. Right now, if I was to look for for an option for a client of over 200,000 square feet, we probably have 2 or 3 quality options in the market. So that's going to stay relatively healthy as far as demand. I think the small bay industrial and lower ceiling height buildings are going to take the brunt of the rental impact in Montreal. I think that's where a lot of those requests for rental abatement. And unfortunately, I think we're going to start seeing more closures of companies in the sector of the industrial market.
Colin, you're muted.
Sorry about that. Seems that my connection is hanging up a little. Apologies for that. Hopefully there wasn't too long of a lag there. But thanks for your answer, Mark. James, how are lenders reacting? Have you seen changes in process, in the size, structure, or any other requirements for loan transactions?
James, I'll let you go first.
Than rent deferral request, which will lead to mortgage sort of restructures and sort of amortization of capital over this period. We've seen lenders collaborating with their clients, again, open to discussions with their best clients. I think what I said at the top of the program is important. Relationships matter, and most lenders are trying to accommodate in their existing relationships. And we've even seen a bunch of new construction loans and et cetera. So again, I've been surprised on the lending side. Are yields a little higher? Sure. I mean, the initial conversations we've had around COVID-19 when it first broke was, force majeure, all these clauses I talked about in the beginning. But with one lender, we took a very practical approach and we said, why don't we just put a floor rate so that the borrower doesn't get penalized over time with a lot of these clauses and et cetera. And that seemed to work well. Covenants, as James Gang said earlier, less on loan to value, more on debt service coverage, maybe more interest reserves, more frequent reporting, no distributions, maybe some cash sweeps, no payments on unsecured debt, more club deals as people want to take fewer risks, and a tighter change of control on covenantors, because covenantors and all of these credit enhancements will be more important. But we haven't seen a massive disruption in the loan market. I was just on a call with some American colleagues, and of course they're always a leading indicator, as James G said. What they're seeing in the CMBS market down there is that hotels have already been, had initially right away migrated to special servicing because their cash flow is daily, so that drop was significant. And they're seeing a migration in the retail space to special servicing and the CMBS programs there, but no particular distress. What they're anticipating, in some states have instituted down there, are eviction and even foreclosure sort of measures and suspensions and freezes in some states. So wondering if that might not come up here, especially in the residential space, right? There are eviction freezes in certain provinces, but you may see that be extended to other asset classes like retail if this thing deepens.
Yeah, hopefully we're on the other side of catastrophe. Or hopefully we're seeing a little bit of light at the end of the tunnel, and that won't be the case. What about physical distancing with regards to executing transactions, virtual closings? What are you seeing there? Is it challenging with regards to having to stay apart from each other?
Well, like most, we've been completely pleasantly surprised by the ease in which we transitioned to a virtual law firm. We've had a business continuity plan in effect for years, and part of that involved buying laptops for everyone and et cetera. So we, within 24 hours, went virtual. We came up with solutions for disbursements. We've also talked to title insurance companies about how to deal with any potential shutdown of registry office by using gap title insurance. We've been in touch with the notarial community about having notarial deeds signed virtually or authorizing someone in the notary's office to sign for a client. So, and we've closed dozens of transactions since this thing started. And it's been quite surprising how it's been very seamless. So business as usual in an unusual time.
It's great to hear that. It took a little bit of forethought, I imagine, but I guess that these are the times when that sort of forethought is tested, of course. So now for the $1 million question, I think everybody wants to know, André and Marc, what, in your opinion, will happen to rental rates going forward?
Well, Colin, I think that for best of class assets, top performers, the better buildings, the rates will stay relatively stable for the next few months. Construction costs are certainly not coming down. So build out costs will continue to increase, and that has an impact on rental rates. And when I say best of class assets, I'm not just referring to trophy properties in the downtown core. I'm also talking about, top loft office space buildings. There's a large inventory of loft office space in Montreal. And I believe the better buildings will continue to retain and attract the better tenants. And we'll see some stability in terms of rental rates are concerned. I also see a window of opportunity for more interest towards mixed-use projects, either on the South Shore, the North Shore, or in the East End. Mixed-use projects with a lot of amenities, with large outdoor piazzas or parks. Companies might consider more seriously opening satellite offices outside of the core to offer, alternatives to their employees that will not necessarily want to use transit as much as they would have before this pandemic.
Marc?
Yeah, I mean, I agree with André that relatively rents will stay stable. Industrial's been the best asset class so far in Montreal, and I think it'll be the asset class that best weathers a storm. I think we really need to separate it into two separate sections, which is really the high bay, distribution, supply chain style buildings. Those will stay very stable, even potentially grow. I don't expect that we're going to see any new supply coming to the market anytime soon. So we don't expect a rollback on those rents. The smaller bay, lower ceiling heights are obviously going to be a little bit more negatively impacted. You're dealing with smaller companies, not as well capitalized, and hopefully that the Quebec government will put a little bit more incentives into the market to get manufacturing back here in Quebec.
Well, thanks for that. It seems like we're at the end of our time, so I'll wrap it up. So although not cyclical, this situation is, well, medical historians tell us that the influenza pandemic occurs maybe 3 times every century. So while some are barely noticed, we're being impacted by the novel COVID-19 virus in ways that will prepare us for future outbreaks. Certainly, the way we think going forward will be impacted, at the very least in the near and the midterm. Crowd-based services, I'm sure, will most certainly be affected and fall away as lifestyle changes will look towards limiting casual physical interaction. But, memory is sometimes short, and I imagine even short and midterm measures will eventually fade, as with past pandemics, giving certainly credence to the saying that this too shall pass. Clearly, the outlook, you can see it, it's differed between investor sentiments polled at the beginning of the outbreak and our most recent survey. Our Montreal market has been an attractive and a stable place to do business, and I'm glad to hear belief from our panelists in the robust strength in the market going forward. I'd like to, first of all, thank our panelists for speaking candidly. You're experts with wide knowledge within your specialties, and we certainly appreciate your insight, and we appreciate your guidance as well. To those listening in, please leave any questions you have by writing them in the chat box that is accessible on your screen. We'll collect them and we'll respond to you via email. For more info on all things related to commercial real estate during the crisis, please visit our microsite. The URL will be shown on the closing screen of this broadcast. You can also find our Q1 office and industrial reports, as well as our Canada Cap Rate report on the research tab at our website, collierscanada.com. So again, thanks for attending. Please stay safe and be well. Have a great day, everybody.